Hello, this is Caroline Bell from Summerhill Financial Services, just with another update. So we've received the cash balances into all of your portfolios. Now we're looking at the cash balances as we do every 2 or 3 weeks, but looking at actually sitting on some cash for a little bit longer. So markets have actually moved quite a lot in the last 6 months and are actually relatively high when we look over their performance over the last couple of years. So rather than just going and investing just because the cash has been received, if you don't hear from us and you do have a little bit of cash, it's more than not likely a deliberate decision where we're just going to be a little bit more cautious and sit on the cash for a little bit longer just to see if the market pulls back a little bit, and then potentially take advantage of the pullback at a later date. Alternatively, depending on the mix of your investment portfolio, we may just be making some recommendations to reinvest that cash into some defensive investments such as fixed interest and bonds. One of the things to note with the portfolios is your portfolio has more than not likely outperformed the rest of the market over the last 12 months. And that is mainly due to small companies and value companies outperforming the rest of the market. As many of you may remember, you have higher than index exposure to these small and value companies in your portfolio, which means that your portfolio has outperformed as well. So one of the things I'm sort of speaking to clients with at the moment as we are having meetings is certainly not to expect some of these returns going forward on a regular basis. But certainly it's nice when these sort of returns do happen. But it's important to remember that it's more likely than not we'll receive single high-digit returns going forward, rather than sort of double-digit returns. In terms of comparing portfolios, an interesting question that we had in the last week or so was just comparing performance to some industry superannuation funds, particularly Catholic Super, Host Plus, CBUS and Australian Super. One of the issues with just doing a straight comparison with the default fund or the default investment portfolio, which is often called their balanced investment portfolio, is that these portfolios are not balanced. I actually have a bit of an issue with them calling them balanced portfolios, because that indicates a balance between share and property investments and cash and fixed interest investments. But in fact, many of these balanced investment portfolios have exposure to share and property investments of anywhere between 77 to 90%, which is incredibly aggressive and much more aggressive than many of the portfolios that I manage, which generally is between 60 to 70% share and property investments. Of course, there's some that are lower and some that are higher as well, depending on the individual. So when comparing portfolios, it's very important to actually look at what the underlying investment mix of the portfolio is, and looking at the percentage exposure of share and property investments between the two different portfolios. If you have any questions or comments, as always, I look forward to hearing from you, but speak with you soon. Bye-bye.